In this video, we're going to continue with the estimation of the present value of a project, taking into consideration depreciation, taxable income or taxes, and now we're going to include external financial sources. In the previous video, we already considered depreciation and taxes, so we are going to concentrate in the modifications associated with the loan in this project, and for more detail, please check the previous video. So we have the same project with initial investment of $300,000, life of the project 7 years. The MACRS system allows us to depreciate this in 5 years. Tax rate 35%, salvage value 45,000, and the minimum attractive rate of return desired by the investor is 15%. So for the first 3-4 columns we have none of the numbers have changed. We are still using the same depreciation for the same cash flows, the same initial investment, and none of that has changed. What we need to include now are 4 columns for the loan amortization table. And we begin with, since the loan is for $210,000, with the amount of time we have to pay this is 5 years. The interest rate is 10%. We can compute the payment every year to be $55,397, as this payment would be the present value, 210,000 times A given P for 10% and 5 periods. So we create the amortization table, starting with 210,000 at year 0. And then we can compute the corresponding interest to be 10% of that amount, 21,000. We subtract 21,000 from 55,397 to obtain the amount in principal, as we have described in the previous video about the amortization tables. And the difference between 55,397 and 21,000 is 34,397, which is used to reduce the amount we owe. Originally 210,000, we subtract, and we obtain now that at the end of the first period we owe only 175,603. The amount of interest for the next period would be 10% of this last balance, and the interest would be $17,560. And again, we subtract that from the payment, total payment $55,397, and now we can reduce the amount we owe by $37,837. And we continue with this process for the next 3 years, and at the end of the 5th year, we have paid off our loan with a balance of 0, and we have columns separated for the amount of interest and the amount of reduction of principal. And pretty much the main idea is that we need to know how much we're paying of interest at every single year. The reason for that is because interests are considered a financial cost, and financial cost can reduce the amount of taxable income. Of course, we prefer not to pay taxes if we legally can do so. So what we do is, from the initial cash flow, we already considered subtracting the depreciation for purposes of taxable income. Now we're going to also subtract the interest, and therefore paying even less taxes when we use these external financial sources. So say, for instance, for year 1, $50,000 is reduced by $60,000 in the depreciation and $21,000 in interest, and that makes the taxable income $31,000 negative. For an example of the case when the taxable income is a positive number, we can look at year 3 with a project cash of $90,000, depreciation of $57,600, and interest of $13,777, with a taxable income now in the positive numbers of $18,623. The rest is computed pretty much as we have done in the past, that we compute the tax as the taxable income times the tax rate for all the rows. And we in column J, the after-tax cash flow now also need to change because we have a couple of major changes. To begin with, the amount of cash that the investor needs is now not 300,000 out of its own pocket, but only 90,000 because the bank is going to finance $210,000. Therefore, the initial investment from the perspective of how much money is needed by the investor is $90,000 or the company if the company is financing its own project. Um, if we continue with this process or with this logic, we need to take into consideration all the cash flows that are affecting uh, this computation. And in this example for year one, $50,000 is the cash flow we receive. Now we need to pay $55,000, 397 in as payment, and also we need to pay taxes for 10,850 negative. So those taxes are going to affect us in a positive way. And bottom line, we end up with a positive cash flow of $5,453. If we continue with this process for the second year, we receive 70,000. We need to subtract the amount that we need to pay to the bank, and that is both interest and principal reduction. That's the complete payment, 55,397. And to that, we need to subtract the taxes, but the taxes in the second year are negative. So now we end up with a positive cash flow of 29,849. And we keep doing that same process for all the years, and that's how we compute column J. For the last column, we can compute the present worth of each one of these after-tax cash flows as that column J, divided by 1 plus the minimum attractive rate of return raised to the period, just the regular present worth formula. And once we have these for all the rows for all these years, we can add them all together to compute the overall present worth of the project to be $49,074. So compare the previous number, $49,074, with $7,766. So you see it's a significant increment in the present worth of the project. And the main reason for that is because now we are paying fewer taxes, and we need a lesser amount of our investment from our own sources, and that makes it a much more attractive project, um, both from the perspective of the present worth and the dollar per dollar invested. So it is very important to do these type of studies and take into consideration all the financial sources available for the projects, because selecting an external financial source when properly done could actually improve the bottom line in these projects.